You're with ChannelVest, your expert in ETF strategies. We're pulling back at the curtain today on our internal report. This is it, the financial blueprint that can turn $50,000 into $500,000.
Exactly. And this is the strategy that separates the long-term winners from, the 87% of DIY portfolios that just fail.
We've got the proprietary findings, we have the mathematical proof. We're giving you the exact framework to make sure you are in that successful 13%. We are going to walk you through our data chart by chart.
And we're going to explore why market psychology costs most people millions. You really need to stick around because the final insights on how to handle market crashes are, well, they're absolutely critical.
Yeah, this isn't theory. This is a proven path to wealth. So before we start diving into this monumental data set, please hit subscribe right now and tell us in the comments below, what's your biggest fear when the market drops 20%? Okay, let's go.
Let's do it. We begin with the foundation. So our first chart is titled, Why 87% of DIY ETF Portfolios Fail, and How to Build One That Doesn't.
This slide, it just establishes the problem immediately. When we looked at the data for 2024, the difference between the market and the average investor was it was profound.
It really was.
The S&P 500 delivered a phenomenal, 5% return, but the average DIY investor, they only captured 16.54%.
That's an 848 basis point gap. And to put that in perspective, that 8.48% difference compounded over a lifetime. That is not a rounding error. That costs investors literally millions in lost wealth.
Right. People aren't failing because they chose bad ETFs.
No, they're failing because they lack a disciplined strategy for navigating fees, volatility, and, most importantly, their own emotions.
We are here to expose those wealth killers and just deliver the solution. Yeah. But we have to start with the necessary legal stuff first. So let's look at the next slide. Important disclaimer.
All right, so as we said, we are providing our research and educational content. This is from our internal analysis. We are not a registered investment advisor, a broker, or a fiduciary. So this isn't personalized financial advice.
You absolutely have to consult a registered professional like a CFP before you implement any strategy we talk about.
And this is critical. ChannelVest earns zero affiliate income from any funds or platforms mentioned. We're just delivering the unbiased math. That's it.
Perfect. Thank you. Now that we've got that out of the way, let's get into the core issue that creates that 848-point failure. This slide is titled, The Brutal Truth. Your portfolio is bleeding money. And this highlights what we call the behavior gap. It should be a massive wake-up call.
The behavior gap is, it's the direct result of investors buying high and selling low. It's usually measured at around a 1% annual drag on returns. But that 1% drag, it's financially devastating.
It is.
Our modeling shows that this single percentage point, driven purely by overtrading or panic selling, means $1 million grows to $5.3 million instead of $6.3 million over 20 years.
$1 million lost. It's just because of fear or anxiety or impatience.
And the examples are crystal clear.
Oh, yeah. Think about the catastrophic decisions so many people made during the 2022 crash. The market dropped, minus 22.94%, and investors just panic sold. They locked in permanent losses.
And then what happened?
They missed the entire 2023 recovery, which delivered a massive 24% gain. You missed $250,000 in recovery because you failed the ultimate psychological test. This blueprint exists to force you to pass that test.
And that's why we have to focus on the engine of compounding. So looking at the next slide, we're talking about the growth phase, building wealth on steroids. If that $500,000 goal is your target, you absolutely need this aggressive engine.
And that engine, for us, is all about tech and innovation, specifically QQQ. The numbers, they just speak for themselves. 19.67% annualized returns over the last 10 years.
It's insane. And even over 20 years, it's still 14.36%. Now, we know what everyone is thinking. It's volatile.
Of course. Yes, QQQ crashed a staggering minus 35.12% in 2022. But what's the critical insight from that volatility?
The insight is twofold. First, high growth funds like QQQ, VUG, VTI. They have to be the core of your strategy when you're young. Second, that dramatic crash is precisely when you must buy more.
Double down.
You have to. Our model shows that $50,000, even at a conservative 9.65% annual growth rate, still becomes $500,000 in 25 years. You use low volatility bonds like AGG strictly as ballast, just to minimize the drawdown so you have the capital to buy the dip.
Understanding that volatility is the price of admission leads us perfectly into the next analysis. Crash survival, what you'll actually experience. You have to train your brain for market pain.
We tracked every major downturn since 2008 to prove one central point. Recovery is inevitable, and it's often incredibly swift. During the 2008 financial crisis, the S&P dropped 49%.
Terrifying.
Absolutely. But the immediate recovery in 2009 delivered a shocking 54.7% gain in QQQ.
Or look at the 2020 COVID crash. That was the fastest market drop in history. A minus 34% plunge in just 33 days.
And it recovered fully in 6 months. It ended the year up 16%.
The key insight here is just undeniable. Every single crash recovers, and the biggest gains happen during that recovery phase. If you stayed invested in 2009, 2020, and 2023, you won. Simple.
But eventually, you graduate from needing aggressive growth to needing reliable cash flow, which brings us to our next phase.
Yes, let's discuss the income phase. Passive income most never reach. This is the moment your portfolio starts paying you to live.
And we break this down into 3 distinct pillars.
Pillar 1 is dividend growth, which for us is SCHD. It's got a 3.57% current yield, but an incredible 11.06% 10-year total return.
Pillar 2 is your higher yield strategies, like covered call funds, think JTI or XYLD. They boast yields between 7.15 and 12.84%.
And pillar 3 is the stabilizer, bonds yielding 4 to 4.5%.
And when you execute this transition properly, that $500,000 portfolio generates significant, reliable, passive income. Using these allocations, we model around $12,500 annually from equities and another $5,600 from bonds.
That's over $1,000 a month,
Yeah.
$1,042 a month flowing right into your bank account. But you have to avoid the most common trap when you're chasing yield.
Ah, yes. And that is exactly why we dedicated this next slide to, the covered call yield trap. This is where so many investors, desperate for high monthly income in retirement, they unknowingly sabotage their future wealth.
Look at the data for JPI. A 7.15% yield sounds amazing, right? But when you look under the hood, the annualized total return since 2020 is only 1.38%.
That's stagnation. That's not growth. And why? Because covered call funds get that high yield by selling options premiums, which caps your upside when the market rips higher.
But the real wealth killer is the tax.
Oh, the tax is brutal. Because those premiums are income, 100% of that yield is taxed as ordinary income. For high earners, that's a top tax rate of 37%.
Compare that to SCHD, the compounding champion. It starts lower at 3.57% yield, but those are generally qualified dividends, so a max 20% tax rate.
That tax difference alone is huge. Our analysis confirms SCHD overtakes JAPI in total value by year 12, even though it started with a yield that was 50% lower. Dividend growth always beats high yield long-term, period.
Okay, we are moving fast here, and the insights are just flowing. If that breakdown of the yield trap just changed how you view retirement income, you need to hit subscribe right now. Don't miss our tax masterclass.
Yeah, and let us know in the comments. Are you still holding any high-yield covered call funds? We want to know your strategy. All right, back to the blueprint.
Let's talk about the absolute most important action you need to take over your career. This is the transition that changes everything. This is the strategy that 95% of DIY investors get wrong, and it leads to sequence of returns risk just crushing their retirement.
The mistake is thinking the transition is based on age. It is not. The transition from growth to income has to be based on hitting a financial target. Specifically, your portfolio hitting 25 to 30 times your annual spending.
Right.
We model this in 4 phases. Years 1 through 10 is maximum growth. We're talking 85% equities, 15% bonds. You maximize compounding.
Then you hit years 11 through 20, the transition phase. You move to a 70-30 split. This is where you bring in your first big chunk of SCHD. You start smoothing out the ride.
By the time you hit the income phase, you have to lock it in. 30% equities, 70% bonds. That gives you stable income and capital preservation. If you miss this controlled shift, you risk a catastrophic sequence of returns disaster right when you retire.
Exactly. Next up, let's discuss a silent killer that costs you more than any market crash. The expense ratio catastrophe. This visual data proves that minimizing fees isn't optional, it's your first priority.
Look at this chart. Compares 2 identical investments over 30 years. You start with $100,000 and a 10% gross return. The difference between a low-cost ETF like VOO at 0.03% and a high-cost mutual fund at 1.5% is...
It's insane. $486,000.
almost $500,000 of your future wealth just gone, vanishes. Purely because you chose a high-fee fund. Our modeling shows every 0.1% in fees costs you roughly 3 to 4 years of future wealth.
If an ETF has an expense ratio over 0.3%, you have to seriously question its value. Fee minimization is non-negotiable.
Right. Now we get to the analysis that defines the best portfolio. This is the portfolio battle royale, the Sharpe ratio hierarchy. This ratio tells us how much return we get for the risk we take.
And the Sharpe ratio is absolutely crucial. It's measuring excess return per unit of volatility. Higher number is better.
And we compared 4 major portfolio types. The decisive winner, with a Sharpe ratio of 0.871, is the Tech-Dividend Hybrid. It delivered an 11.65% return with contained volatility. It's the best balance of risk and reward on the board.
To put that in perspective, the aggressive growth portfolio delivered a higher absolute return, 15.4%, but it came with 53% more volatility.
So the hybrid captures 3/4 of that aggressive growth upside, but with 34% less volatility. That is the difference between sleeping at night during a correction and panic selling at the absolute bottom.
Speaking of risk, we have to talk about the huge shift that changed modern investing. The 2022 correlation collapse. 150 years of theory broke. The old 60/40 portfolio it's fundamentally broken. Here's why.
For 150 years, the promise of bonds was safety. When stocks fell 20%, bonds were negatively correlated. They usually rose. The average stock-bond correlation was minus 0.15.
That was the whole reason to own bonds, to act as a counterweight.
Then came 2022. Spiking inflation forced the Fed to raise interest rates aggressively, and it crushed both asset classes at the same time. The S&P fell 19.4%, and bonds fell 13%.
The correlation flipped violently to positive 0.68. They crashed together. BlackRock even said the 60/40 portfolio had its worst performance in 150 years. The old rules are dead.
And our solution relies on durable compounding power, which is revealed in our next analysis. Dividend Growth Deep Dive, the yield on cost supernova. This proves that your starting yield often betrays your future income.
We tracked two major stocks since 2008. Visa versus Verizon. Visa started with a tiny, almost irrelevant 0.5% yield.
Yeah.
Verizon looked way better with a generous 4.5% yield. Day one, everyone picks Verizon.
Of course. But fast forward 16 years, Visa's dividend grew at an annual rate of 22%, just massive growth. Today, the dividend yield on your original Visa shares is a jaw-dropping 8.5% yield on cost.
And Verizon. It barely increased its payout. It inched from 4.5% to just 6.1% yield on cost. The initial yield is a lie. True freedom comes from exponential dividend growth.
So let's make this information actionable for you right now. Here are the specific blueprints under the title, Retirement.
Okay, if you are aged 25 to 35, you have to be in max accumulation mode. That allocation looks like 60% growth holdings QQQ, VUG, 20% dividend growth SCHD, and 15% bonds for ballast. That mix targets an 11 to 13% expected return.
But when you hit age 65 plus, the formula shifts to pure income. We're talking 40% dividend, 40% bonds, and a cash buffer. This ensures that $500,000 portfolio generates over $1,300 a month, reliably.
We've given you the math, the allocation, the transition strategy. Ultimately, though, success comes down to your commitment. This is why we analyzed the 5 scenarios that determine your future.
We simulated every reality, from boom times to multi-year financial disasters. And the difference between holding firm during a nightmare scenario and panic selling is a colossal $438,000.
$438,000 lost purely to fear.
In the most likely reality, your success rate is 92%. But only if you commit to the plan and execute it without deviation. The real test is sticking to the blueprint when the market is trying to break you.
And that brings us to our final summary. Subscribe and don't miss our next video. We have laid out the entire playbook for you.
We confirm the foundational math one last time. $50,000 grows to $500,000 in 25 years, with a 9.65% TAGR.
So your actionable checklist starts now. Choose your age-appropriate allocation, open your account, purchase the 5 core ETFs we discussed, set those rebalancing reminders, and most crucially, never, under any circumstances, panic sell during a market crash.
And we are not stopping here. Our next deep dive is going to be crucial for maximizing those returns. We are talking about the tax loss harvesting masterclass. Add 1-2% to your returns.
This strategy, when you execute it properly, can save you thousands every year, compounding to $100,000 or more over 20 years.
You simply cannot afford to miss that session.
Hit subscribe and turn on notifications so you don't miss it. Take control of your portfolio, and we'll see you next time for the masterclass.